The guaranteed insurability rider is not modified or defeated by the existence of other riders. Example: Alan's life insurance policy contains both guaranteed insurability and waiver of premium rider. 3 years after the policy was issued, Alan was totally and permanently disabled. Not only are Alan's life insurance premiums waived, but at the specified times or events stated in the policy, Alan may purchase additional amount of insurance with the premiums on those increases also waived. Return of premium. The return of premium rider is implemented by using increasing term insurance. When added to a whole life policy, it provides that at death prior to a given age, not only is the original face amount payable, but an amount equal to all premiums previously paid is also payable to the beneficiary. The return of premium rider usually expires at a specified age such as age 60. Term riders. Term riders allow for an additional amount of temporary insurance to be provided on the insured, without the need to issue another policy. They are usually attached to a whole life policy to provide greater protection at a reduced cost. Accelerated living, BENE, FI, TS and long-term care riders. Accelerated death benefits allow the early payment of a portion of the death benefit if the insured has any of the following conditions: a terminal illness, a medical condition that requires an extraordinary medical intervention, such as an organ transplant, for the insured to survive, a medical condition that without extensive treatment drastically limits the insured's lifetime, inability to perform activities of daily living, ADLs, permanent institutionalization or confinement to a long-term care facility, or any other conditions approved by the Department of Insurance. The maximum benefit is typically a percentage of the face amount of insurance, usually 50%, but it is legal for the insurer to pay up to 100% of the death benefits before the insured dies. There may also be a dollar limit, such as $100,000. The face amount of insurance is reduced after the payments. The accelerated death benefit payout will not necessarily result in a reduction of the premium. However, premium may be waived. The living needs rider provides for the payment of part of the policy death benefit if the insured is diagnosed with a terminal illness that will result in death within 2 years. The purpose of this rider is to provide the insured with the necessary funds to take care of necessary medical and nursing home expenses that incur as a result of the terminal illness. Many insurance companies do not charge for this rider since it is simply an advance payment of the death benefit. The remainder of the policy proceeds are payable to the beneficiary at the time of the insured's death. Know this: accelerated benefit equals early payment of part of death benefit to the insured from the insurer for qualifying medical expenses. Long-term care, lieutenant colonel coverage, which is often purchased as a separate policy, can also be marketed as a rider to a life insurance policy. These riders provide for the payment of part of the death benefit, called accelerated benefits, in order to take care of the insured's health care expenses, which are incurred in a nursing or convalescent home. As with the living needs rider, payment of LTC benefits will reduce the amount payable to the beneficiary upon the insured's death. Effective death benefit. If an insured withdraws a portion of the face amount by the use of the accelerated benefits rider, the benefit payable at death will be reduced by that amount, plus the amount of earnings lost by the insurance company in interest income. Payable death benefit equals face amount withdrawn earnings lost by insurer in interest. Example: the policy's face amount is $100,000. However, due to a terminal illness, the insured had to withdraw $30,000 from the policy 3 years before his death. Since this amount was withdrawn, the insurance company lost $300 worth of interest. Upon the insured's death, the beneficiary received $69,700 in death benefit. $100,000 face amount, $30,000 accelerated benefit, $300 lost interest, equals $69,700. Cost of living. The cost of living rider addresses the inflation factor by automatically increasing the amount of insurance without evidence of insurability from the insured. The face value of the policy may be increased by a cost of living factor tied to an inflation index such as the Consumer Price Index, CPI. Here's a breakdown of the most common riders available in life insurance policies. Type of rider. Available riders. Disability riders. Waiver of premium. Waiver of monthly deduction. Payer benefit. Disability income. Accelerated living benefit. Riders covering additional insured, spouse, children, family, non-family. Riders affecting death benefit, accelerated death benefit, accidental death or AD&D, guaranteed insurability, return of premium, term riders. Policy options. Policy owners have decisions to make about how the cash value in the policy should be protected, how the return of excess premium, dividends, should be invested, and how benefit payments will be made. The different choices available to them are categorized as non-forfeiture options, dividend options, and settlement options. 1. Non-forfeiture options. Because permanent life insurance policies have cash values, certain guarantees are built into the policy that cannot be forfeited by the policy owner. These guarantees, known as non-forfeiture values, are required by state law to be included in the policy. A table showing the non-forfeiture values for a minimum period of 20 years must be included in the policy. The policy owner chooses one of the following non-forfeiture options: cash surrender value, reduced paid-up insurance, or extended term. Know this. Non-forfeiture options are triggered by policy surrender or lapse. Cash. The policy owner simply surrenders the policy for the current cash value at a time when coverage is no longer needed or affordable. Upon receipt of the cash surrender value, if the cash value exceeds premiums paid, the excess is taxable as ordinary income. Once this option is selected, the insured is no longer covered. A policy that has been surrendered for its cash value cannot be reinstated. A surrender charge is a fee charged to the insured when a life policy or annuity is surrendered for its cash value. Reduced paid-up insurance. Under this option, the policy cash value is used by the insurer as a single premium to purchase a completely paid-up permanent policy that has a reduced face amount from that of the former policy. The new reduced policy builds its own cash value and will remain in force until death or maturity. Extended term. Under the extended term option, the insurer uses the policy cash value to convert to term insurance for the same face amount as the former permanent policy. The duration of the new term coverage lasts for as long a period as the amount of cash value will purchase. If the policy owner has neglected to select one of these non-forfeiture options, the insurer will automatically implement the extended term option in the event of termination of the original policy. Know this. Extended term is the automatic non-forfeiture option. Same face amount, shorter term of coverage. Example. Review a sample table of guaranteed values below. If the insured chooses to exercise the reduced paid-up option at the end of 15 years, the cash value of $8,100 can be used as a single premium to purchase paid-up insurance of the same type as the original policy. The insured doesn't have to pay any more premiums, while still retaining some amount of life insurance. In this example, $21,750. The extended term option indicates the option to use the policy's cash value to purchase in a single premium a term insurance policy in an amount equal to the original policy's face value. In this case, term insurance with $50,000 face amount. The insurance company determines that for this particular insured, $8,100 of cash value is worth 18 years and 8 days of $50,000 of protection. Table of guaranteed values. $50,000 whole life non-forfeiture table, 20 years. End of policy. Year. Cash or loan. Value. Reduced. Paid up. Extended. Term. Years. Days. 1. $0. $0. 0. 60. 2. $50. $250. 0. 122. 3. $400. $1,600. 2. 147. 4. $950. $3,600. 5. 27. 5. $1,550. $5,650. 7. 183. 6. $2,150. $7,600. 9. 185. 7. $2,750. $9,400. 11. 52. 8. $3,350. $11,100. 12. 186. 9. $4,000. $12,850. 13. 315. 10. $4,650. $14,500. 15. 6. 11. $5,300. $16,050. 15. 333. 12. $6,000. $17,600. 16. 249. 13. $6,700. $19,100. 17. 95. 14. $7,400. $20,450. 17. 255. 15. $8,100. $21,750. 18. 8. 16. $8,650. $23,050. 18. 116. 17. $9,850. $24,440. 18. 208. 18. $10,400. $25,550. 18. 227. 19. $11,200. $26,750. 18. 231. 20. $12,000. $27,850. 18. 200. Lasts the longest. Provides the most. 2. Dividends and dividend options. Dividends are paid only on participating policies. When the policy owner purchases a policy from a participating insurer, he or she actually pays a grossed-up premium. The higher premium is charged as a safety margin in the event the insurer's losses are higher than anticipated. If this extra amount is not needed by the insurer to pay death claims and expenses, or if actual mortality experience improves or interest earned by the company exceeds the assumptions, a dividend will be returned to the policy owner. In other words, dividends are a return of excess premiums, and for that reason they are not taxable to the policy owner. Insurance companies cannot guarantee dividends. The first dividend could be paid as early as the first policy anniversary, but must occur no later than the end of the third policy year. From then on, dividends are usually paid on an annual basis. Policy owners have the option of taking their dividends in one of several different ways. Know this: dividends are a return of excess premiums, therefore, not taxable when paid to the policy owner. Cash The insurer simply sends the policy owner a check for the amount of the dividend, as it is declared, usually annually. Reduction of premiums. The insurer uses the dividend to reduce the next year's premium. For example, if the policy owner usually pays an annual premium of $1,000 and the insurer declares a $100 dividend, the policy owner would only pay a $900 premium that year. Accumulation at interest. The insurance company keeps the dividend in an account where it accumulates interest. The policy owner is allowed to withdraw the dividends at any time. The amount of interest is specified in the policy and compounds annually. Although the dividends themselves are not taxable, the interest on the dividends is taxable to the policy owner when credited to the policy, whether or not the policy owner receives the interest. Paid-up additions. The dividends are used to purchase a single premium policy in addition to the face amount of the permanent policy. No new separate policies are issued, however. Each of these small single premium payments will increase the death benefit of the original policy by whatever amount the dividend will buy. In addition, each of these paid-up policies will accumulate cash value and pay dividends. The amount of additional coverage that can be purchased with the dividend is based on the insured's attained age at the time the dividend is declared. If the policy owner did not choose the dividend option, the insurer will automatically use paid-up additions to increase the death benefit of the original policy by the amount the dividend will buy. Paid-up option. Usually, the insurer first accumulates the dividends at interest and then uses the accumulated dividends, plus interest, and the policy cash value to pay the policy up early. In other words, if the insured had a continuous premium whole life policy, in which premiums are paid to age 100, using the paid-up option, the policy owner is able to pay up the policy early. 1-year term option. The insurance company uses the dividend to purchase additional insurance in the form of 1-year term insurance. That increases the overall policy death benefit. The policy owner's choice is to either use the dividend as a single premium on as much 1-year term insurance as it will buy, or to purchase term insurance equal to the policy's cash value for as long as it will last. If the insured dies during the 1-year term, the beneficiary receives both the death benefit of the original policy and the death benefit of the 1-year term insurance. 3. Settlement options. Settlement options are the methods used to pay the death benefits to a beneficiary upon the insured's death, or to pay the endowment benefit if the insured lives to the endowment date. The policy owner may select a settlement option at the time of policy application, and may also change that option at any time during the life of the insured. Once selected by the policy owner, the settlement option cannot be changed by the beneficiary. If the policy owner does not select a settlement option, the beneficiary will be allowed to choose one at the time of the insured's death. Know this: settlement options are triggered by the insured's death or age. 100. Cash, lump sum, payment. Upon the death of the insured, or at the point of endowment, the contract is designed to pay the proceeds in cash, called a lump sum, unless the recipient chooses a different mode of settlement. If no selection is made, the proceeds are automatically paid to the beneficiary in a single cash payment. As a rule, payments of the principal face amount after the insured's death are not taxable as income. Life income. The life income option, also known as straight life, provides the recipient with an income that he or she cannot outlive. Installment payments are guaranteed for as long as the recipient lives, irrespective of the date of death. The amount of each installment paid is based on the recipient's life expectancy and the amount of principal. If the beneficiary lives for a very long time, payments may exceed the total principal. However, if the beneficiary dies shortly after he or she begins Receiving installments, the balance of the principal is forfeited to the insurer. Because there is a chance that the beneficiary may not live long enough to receive all the life insurance proceeds, insurers make options available which provide at least a partial guarantee that some or all of the proceeds will be paid out. With each of the guarantees, the size of the installment is decreased. Know this. Under life income, straight life, settlement option, the recipient cannot outlive the benefit payments. Under life income with period certain option, the recipient is provided with the best of both worlds, in terms of a lifetime income and a guaranteed installment. Period. Not only are the payments guaranteed for the lifetime of the recipient, but there is also a specified period that is guaranteed. For example, a life income with 10 years certain option would provide the recipient with an income for as long as he or she lives. If the recipient dies shortly after starting to receive the payments will be continued to a beneficiary for the remainder of the 10-year period. As already stated, the installments for the life income with period certain option will be smaller than the life income only option. The life income joint and survivor option guarantees an income for 2 or more recipients for as long as they live. Most contracts provide that the surviving recipient will receive a reduced payment after the first recipient dies. Most commonly, the reduced option is written as joint and 1/2 survivor, or joint and 2/3 survivor, in which the surviving beneficiary receives 1/2 or 2/3 of what was received when both beneficiaries were alive. This option is commonly selected by the policy owner who wants to protect two beneficiaries, such as elderly parents. Unless a period certain option is also chosen, as with the life income option, there is no guarantee that all the life insurance proceeds will be paid out if all beneficiaries die shortly after the installments begin. This option guarantees, however, an income for the lives of all beneficiaries. Interest only. With the interest-only option, the insurance company retains the policy proceeds and pays interest on the proceeds to the recipient, beneficiary, at regular intervals, monthly, quarterly, semi-annually, or annually. The insurer usually guarantees a certain rate of interest and will often pay interest in excess of the guaranteed rate. The interest option is considered to be a temporary option since the proceeds are retained by the insurer until some later point when the proceeds are paid out in a lump sum or paid under one of the other settlement options. When the beneficiary is allowed to select a settlement option, the interest option is sometimes used as a temporary option if the beneficiary needs some time to decide which settlement option to select. For example, the policy owner may specify that interest only will be paid annually to the surviving spouse, with the principal to be paid to their children when they reach a certain age or at the death of the surviving spouse. Fixed period. Under the fixed period installments option, also called period certain, a specified period of years is selected, and equal installments are paid to the recipient. The payments will continue for the specified period even if the recipient dies before the end of that period. In the event of the recipient's death, the payments would continue to a beneficiary. The size of each installment is determined by the amount of principal, guaranteed interest, and the length of period selected. The longer the period selected, the smaller each installment will be. This option does not guarantee income for the life of the beneficiary. However, it does guarantee that the entire principal will be distributed. Fixed amount. The fixed amount installments option pays a fixed, specified amount in installments until the proceeds, principal and interest, are exhausted. The recipient selects a specified fixed dollar amount to be paid until the proceeds are gone. If the beneficiary dies before the proceeds are exhausted, installments will continue to be paid to a contingent beneficiary until all proceeds have been paid out. With this option, the size of each installment will determine how long benefits will be received. The larger the installment, the shorter the income period will be. As with the fixed period option, this option does not guarantee payments for the life of the beneficiary, but does guarantee that all proceeds will be paid out. Option type. Available options: non-forfeiture options, reduced paid up, extended term, automatic, cash, dividend options, cash, reduction of premium, accumulation at interest, paid up additions, automatic, paid up insurance, 1-year term, settlement options, cash, automatic, life income, interest only, fixed period, fixed amount. F-Chapter Recap. In this chapter, you learned about provisions, options and riders available in life insurance policies. Remember that provisions state the rights and obligations under the contract. Riders modify provisions, and options specify ways to distribute policy proceeds. Let's recap the major points of this chapter. Policy provisions. Standard provisions. Consideration. Parties to a contract exchange something of value. Entire contract. Policy, with riders and amendments, and copy of the application. Grace period. Time period after the premium is due during which the policy will not lapse. Incontestability. Insurer cannot contest misstatements on the application after a time period. Insuring clause. Basic agreement between the insurer and the policy owner. Misstatement of age or gender. Death benefit is adjusted according to the correct age and gender at policy issue. Payment of premiums. Premiums are paid in advance. Reinstatement. A policy can be restored within a specified period of time with proof of insurability. Other provisions. Assignment. Absolute or collateral. Exclusions. Aviation, non-commercial, hazardous. Occupation, war or military service. Suicide within a specified time period. Free look. Policy can be returned for a refund of premium within a specified time period. Ownership. Policy owner's rights. Beneficiaries. Designations. Individuals, including minors, classes. Estates. Succession. The levels of priority. Each level in the succession is only eligible if the beneficiary in the level above has died. Primary. First claim to the policy proceeds. Contingent, secondary, tertiary. Next claim after primary. Policy owner's right to change a beneficiary. Revocable can be changed at any time. Irrevocable can only be changed with the beneficiary's consent. Common disaster clause. Protects the rights of contingent beneficiaries, if the insured and the primary beneficiary died at approximately the same time, it is assumed that the primary beneficiary died first. Policy loans, withdrawals and partial surrenders. Cash loans available. Policy's cash value minus any unpaid loans and interest. Automatic premium loans. Prevent unintentional policy lapse due to non-payment of premium. Riders. Disability. Waiver of premium. Waives the premium if the insured becomes totally disabled. 6-month waiting period before benefits begin. Waiver of monthly deductions. Waives the cost of insurance in the event of the insured's disability. Payer benefit. Functions like a waiver of premium rider, used for juvenile policies. Accelerated benefit. Early payment if insured is diagnosed with a specie. Phi. Ed. Catastrophic illness. A portion of the death benefit. Death benefit is reduced by the amount paid plus earnings lost by the insurer. Additional insured. Spouse, other insured. Term rider, limited time, limited coverage. Usually expires when spouse turns age 65. Children's term. Covers all children of the insured, limited time, limited coverage. Can be converted to a permanent policy. Non-family insured. Used by businesses, e.g. key person insurance. Riders that affect the death benefit. Accidental death. Pays double or triple indemnity if accidental death occurs as defined in the policy. Death must occur within 90 days of accident. Guaranteed insurability. Allows for purchase of additional insurance at specified times without evidence of insurability at the insured's attained age. Return of premium. Increasing term is added to a whole life policy that provides that if death occurs prior to a given age, not only is the death benefit payable to the beneficiary, but all premiums paid as well. Options. Non-forfeiture. Reduced paid-up insurance uses cash value as a single premium to purchase a permanent policy with a reduced face amount. Extended term. Automatic option. Uses cash value to convert to term insurance. Cash surrender value. After that, no more insurance. Dividend. Cash. Insurer sends a check to the insured. Reduction of premium. Dividend is applied to the next year's premium. Accumulation at interest. Insurer keeps the dividend in an account where it accumulates interest. Paid-up addition dividend is used to increase the face amount. Paid-up insurance. Dividend is used to pay up a policy early. 1-year term. Dividend is used to buy additional insurance. Settlement. Cash. Lump sum payment. Usually not taxable. Life income. Provides an income the beneficiary cannot outlive. No guarantee that the entire principal will be paid out if the beneficiary dies too soon. Available as single life or as joint and survivor. Interest only. Insurer retains the principal and only pays out interest. Fixed period. Payments for a specified time period until all the proceeds are paid out. Fixed amount. Payments in specified amounts until all the proceeds are paid out. Thanks for watching.